So next, we're going to learn about types of investment companies and how these investment companies operate. It's important to know that the Investment Company Acts of 1940 is what identifies an investment company. So the Acts identifies three primary structures you want to make sure you know. So the first structure is management companies. Types of management companies is open end versus closed ends. Anytime you see open ends, you want to think mutual funds. And whenever you see closed ends, you want to think more so trading on the secondary market. Mutual funds, open ends, closed end, secondary market. And we're going to go into details about open and closed. But the second type of structure that's considered an investment company under the Investment Company Acts of 1940 is unit investment trusts. So unit investment trusts, you want to remember, is an investment company organized under a trust. A few points for unit investment trusts. You want to remember UITs do not have a board of directors. Instead of a board of directors, they have trustees. Unit investment trusts create a portfolio of securities designed to meet the objective of the trust. You want to remember UITs sell redeemable units or shares. So unit investment trusts are redeemable. They sell redeemable units. You want to remember unit investment trusts are fixed and not managed. It has no active management. And unit investment trusts have a fixed end or maturity date. When it comes to shares in a unit investment trust, each share is an undivided interest in the entire underlying portfolio. Each share of a unit investment trust is an undivided interest in the entire underlying portfolio. So it's important to remember unit investment trusts are not managed, once again. So you want to think fixed, not managed, redeemable for unit investment trusts. And then you have face amount certificates. A face amount certificate is a contract between an investor and an issuer in which the issuer guarantees payment of a stated face amount to the investor at some set date in the future. In return for this future payment, the investor agrees to pay the issuer a set amount of money, either as a lump sum or in periodic installments. So once again, unit investment trusts, you want to think fixed, not actively managed, and redeemable. Face amount certificates, you want to think set prices at set dates. Now, when it comes to mutual funds, open-end versus closed-end funds, there's different share classes and there's a different structure when it comes to open-end versus closed-end. So once again, when it comes to open-end funds, always think open-end is mutual funds. Mutual funds have a continuous primary offering. So that's how they raise capital, issuing shares to the public. Primary offering always means public. Issuing to the public is a primary offering. When it comes to open-end funds, an open-end company only issues one class of security, which is common stock. So open-end funds only issue common stock. It does not trade on the secondary market. Secondary market, you want to think the New York Stock Exchange is a secondary market, but it does not trade on the secondary market. It is a continuous primary offering issued directly to the public, you could think. Open-end funds are also redeemable, just like unit investment trusts. Open-end funds may borrow to meet redemptions or to pay expenses. Open-end funds register in open offering with the SEC. With open-end funds, with mutual funds, companies can raise an unlimited amount of investment capital because they continuously offer new shares to the public. So that, can raise an unlimited amount of capital for the corporation. When it comes to open-end funds, when investors want to sell their holdings in these companies, the fund itself redeems those shares at the fund's current net asset value. So you want to remember, open-end mutual funds are redeemable at the current net asset value. Redeemable at NAV, net asset value. In mutual funds, when are they priced? Mutual funds are priced at the end of each business day at a minimum. So open-end funds are priced at the end of each business day. They may calculate net asset value more than once per day. And mutual funds may issue full or partial shares. They can issue full or partial shares. When it comes to closed-end funds, a closed-end company will raise capital by issuing common stock. With closed-end funds, in the initial offering, the company registers a fixed number of shares with the SEC and offers them to the public. But with closed-end, how does it get its name? Is because once the shares have been sold, the fund is closed to new investors. So closed-end, once the shares have been sold, the fund is closed to new investors. So there's no continuous offering. the way open-end does. Unlike open-end funds that only issue one class of security, which is common stock, closed-end funds may issue bonds and preferred stock. So not just common stock. So with a closed-end fund, after its initial public offering, after it starts off issuing shares to the public, you want to think once it closes, once shares have been sold and it's closed to new investors, investors may buy or sell shares in the secondary market. So closed-end funds are involved in the secondary market. You want to connect secondary market with closed-end. So like the New York Stock Exchange is a secondary market. And when it comes to closed-end funds, supply and demand determine the price at which an investor can buy and sell in the secondary market. Closed-end funds have shares that may trade above, which be at premium, or below at a discount of the net asset value. When it comes to share classes of mutual funds and lowering costs of mutual funds, offer different classes to shift how sales loads, which are commissions, are paid. So there's 3 types of share classes when it comes to mutual funds. You have Class A shares. You always want to remember front end load. So there's a sales charge at the beginning, investing into a Class A share. So that is a front end load. Investors pay the fee when buying the shares. It features a low ongoing operating expenses. And Class A shares are ideal for large, long-term investors. Class A shares are ideal for large, long-term investors. See, one thing, Class A shares have an entry fee. They have a front-end sales charge, a front-end load. And then you have Class B shares. Class B, you want to think B can mean back. Class B shares have a back-end sales load, which is also called a contingent deferred sales charge. So you could think B means back-end, also known as a contingent deferred sales charge. A back-end sales charge is paid at the time an investor redeems shares. And then you want to remember, Class B shares can convert to Class A shares. And then you have Class C shares, also known as level load. Class C shares do not have a front-end load. Instead, they have a 0.25%, 0.25% annual shareholder service fee. And that would be charged quarterly. These fees never go away. So Class C shares are commonly referred to as having a level load. So just think that 0.25% service fee is consistent. It's just a flat fee. It's level. Class C shares typically have a 1 year, 1% contingent deferred sales charge to discourage short-term trading of the fund. And Class C shares often have a 12B1 fee, which is an expense that is covered. You'll learn that later on in further lessons. But connects 12B1 fees with Class C, connects 1% contingent deferred sales charge with Class C, and connects 0.25 annual service fee with Class C. So when it comes to reducing sales charges, in particular, a front end load, so mainly focusing on Class A, because Class A has the front end load. So front end load funds typically have lower expense ratios, making them more efficient for most people to invest. When it comes to the sales charge up front, you could basically think of a sales charge as like tipping a waiter for their service. So you could think of a sales charge like a tip to a waiter. So that sales charge would occur front end with Class A. If you're somebody who would maybe want to reduce the sales charge, then you can do that by taking advantage in utilizing breakpoints. Breakpoints are quantity discounts on mutual funds. So they could discount the sales charges. The greater the dollar amount of a purchase, the lower the sales charge. So in other words, the more you invest into a Class A mutual fund, you will hit breakpoints that can lower your sales charge. An example could be like, let's say you have 70,000 invested, but instead of 70,000, if you have 100,000, there can be a breakpoint at that 100,000 mark that would lower your sales charge. There is no industry standard breakpoint schedule, so they can vary across all the mutual fund families. But breakpoints only apply to Class A shares. So you want to remember, breakpoints are good for the clients. If they invest enough money to reach a breakpoint, they can get a discount on the sales charge. So breakpoints are good, but a breakpoint sale would be bad. A breakpoint sale would be basically an agent allowing a client to invest an amount that's just below an amount that would get them that discount. So let's say they'll get a discount at 100,000, but instead of helping the client invest 100,000 so that they can lower their sales charge, you just let them invest 90,000 or 95,000. That's right below the break point. So that would be what's known as a breakpoint sale, which would be, not good to do. Next, you have letter of intent. Letter of intent is when a person who plans to invest more money with the same mutual fund may decrease the sales charges by signing a letter of intent. In the letter of intent, the investor tells the fund company of their intention to add the additional funds needed to reach a specified breakpoint within 13 months. The fund then applies the better breakpoint to all purchases made in the 13-month period. So once again, let's say, the break point is at 100,000. If you can get 100,000 invested into the fund, you'll get a discount on the sales charge. But let's say you want to do that, but you don't have the full 100,000 right now. Let's say you can only invest 80,000, and then you let the company know, hey, I'll have that extra 20,000 later, so I can get that break point. So if you promise, hey, I'll have that extra 20,000 later, so I can get the break point discount, then you would just sign a letter of intent that you intend to invest the missing amount for the discount. And they give you 13 months to do it. And then for rights of accumulation, like breakpoints, allow an investor to qualify for reduced sales charges. The major difference is that, unlike breakpoints, rights of accumulation are available only for later investments. Rights of accumulation allow for reduced sales charges that will not apply to the first transaction. Rights of accumulation allow the investor to use any growth in the share price to qualify for breakpoints. And rights of accumulation do not impose time limits. Like how a letter of intent has 13 months, rights of accumulation do not impose time limits. When it comes to how funds are priced and how dividends are paid, you have forward pricing. With forward pricing, when a broker-dealer or fund sponsor receives a trade transaction request from an investor, that order is passed to the fund. The mutual fund processes the transaction based on the next net asset value calculation. The transaction price is based on the next time net asset value is calculated going forward. So you want to remember, forward pricing is based on the next calculation of the net asset value. So not yesterday's calculation of NAV, not today's, but forward pricing is based on the next time net asset value is calculated going forward. That is why it is called forward pricing. Most funds calculate net asset value once per day, following the close of trading. So, most mutual fund transactions are processed once a day following that calculation. Forward pricing equals calculation of the next NAV. And then you have what is known as a public offering price. With the public offering price, it's the price an investor pays for a share. So how do you calculate a public offering price? You would just take net asset value plus a sales charge equals public offering price. Net asset value plus sales charge equals public offering price. Now, a few points to remember about that equation formula is when it comes to a load fund, so let's say like a front end load or a back end, the public offering price will always be greater than the NAV. With a front load or back load, public offering price will always be greater than the NAV, the net asset value. But let's say a Class C, the net asset value will equal the public offering price. And for closed-end funds trading in the secondary market, the net asset value may be higher, lower, or equal to the public offering price. So if you see a question where the net asset value is higher than the public offering price, that is a closed-end fund. When it comes to fund roles, a custodian versus a transfer agent. A custodian is an independent bank that safely holds the fund's cash and securities, but it does not manage the money. It just holds the money. So you can think of a custodian as like a bank vault. A transfer agent is the one that handles customer documentation, issues and redeems fund shares, and distributes dividends. So you can think of a transfer agent like an assistant. When it comes to disclosure documents and taxes, you also remember a prospectus is important when it comes to offering to the public. Because mutual funds are in a state of continuous primary registration, they must deliver a statutory or summary prospectus at or prior to the time of solicitation or sale. So you can think of a prospectus as like an overview of a sale that can take place. So you want that prospectus to be given to the client at or prior to sale or solicitation. They would need that overview. So just like a disclosure brochure. And then when it comes to what is known as the conduit pipeline theory, the conduit theory allows an investment company to avoid taxes on the dividends it pays shareholders if they meet certain criteria. There are 3 criteria for an investment company to be treated as a conduit for taxes. That's if the company qualifies for this treatment under subchapter M of the Internal Revenue Code. You don't need to know any specifics about the Internal Revenue Code. The investment company calculates its net investment income. How would they determine their net investment income? They would just take their dividends plus interest minus expenses. Dividends plus interest minus expenses equals net investment income. And then the third criteria a company would need to meet to avoid taxes on the dividends they pay is if the investment company distributes at least 90% of the fund's net investment income in dividends. And then you have annuities. The 2 main types of annuities out there are fixed annuities and variable annuities. You want to think annuities provide income for life for those who may have taken an insurance license already. You should remember annuities can provide income for life. is often used for retirement income. There is no limit to the amount of money that may be invested in an annuity. How does an annuity work? The investor puts money into an annuity where it grows tax deferred, meaning the investor doesn't pay taxes until money is withdrawn. So while it's growing tax deferred, no taxes on growth, this is called the accumulation phase. At retirement, the investor begins to receive an income. So when the investor receives an income at retirement, that is called annuitization. The period during which investors receive payments would also be called the annuity phase. When it comes to fixed annuities, some key points you want to remember is that fixed annuities, the contract has a set interest rate during the growth phase, also known as accumulation phase. The rate may fluctuate from year to year, but it'll never be less than zero. So it'll always be a minimum rate. It'll never drop too far. When the annuitant chooses to begin payments, called annuitization, the amount is fixed based on a formula and the payment does not change. So that's why it is called a fixed annuity. When an annuitant chooses to begin payments, the amount is fixed based on a formula and the payment does not change. Receiving income, once again, is called annuity phase, annuitization. The money that the investor put into an annuity is called premium, and the insurance company must pay the guaranteed return even if the investment return does not cover the costs. This is called investment risk. So when it comes to fixed annuities, the insurance company is the one that has investment risk. And with fixed annuities, the rate of return and fixed payments may not keep pace with inflation. So you want to remember, inflation can hurt the value, the power of a fixed annuity. This is called inflation or purchasing power risk. So the investor takes on inflation risk in a fixed annuity. The company takes on investment risk. The investor takes on inflation risk. Fixed annuities only require a life insurance license to sell, not a securities license. And then you have variable annuities, where with variable annuities, to give investors an opportunity to keep pace with inflation, companies introduced the variable annuity. So in a VA, a variable annuity, the investor takes on the investment risk. Few points to remember with variable annuities. Always want to remember, premiums are placed into a separate account. So always think separate accounts with variable annuities. The value of a separate account fluctuates with the investment returns of the sub-accounts. The returns may exceed the rate of inflation, but are not guaranteed to do so. So there's no guarantees with variable annuities. And with variable annuities, all fees must be disclosed, such as administrative fees, investment advisor fees, custodial fees, and surrender charges must be disclosed. If an annuitant dies during the accumulation period while the money is growing and it hasn't been annuitized or distributed yet, the beneficiary receives the greater of the account value or the premiums paid. And with variable annuities, that requires both a securities license and a life insurance license.